Demystifying the mortgage maze. Hey everyone, welcome back to the stuff you should think about. I'm your host G, and I'm so glad you're here. So today we're tackling something that sounds like it belongs in a dusty textbook written by someone who wears three-piece suits and stares at spreadsheets all day. We're talking about mortgages. I know. Yeah, you're already rolling your eyes, but here's the thing. Most of us at some point are going to be faced with the biggest financial decision of our lives. We're going to be asked to sign a document that spans 4 inches thick, full of jargon that sounds like Latin mixed with legalese. And usually we just sign it because, well, that's how you get the house, right? But what if you actually misunderstood what was happening behind the curtain? What if you knew how the bank actually makes money off you and why that 30-year term feels like it lasts for an eternity? Today, it's just you and me. And let's break down the mortgage, the absolute basics. So the next time you walk into a bank, you're not just a signature, you're an informed participant. So let's get into it. Before we dive into the how, let's talk about the why. You've heard the old adage, rent is just throwing money away, but a mortgage is building equity. It's a catchy phrase, but it's a bit of a half truth. When you pay rent, you're paying for a service, shelter, maintenance, and the freedom to move out in a year. When you pay a mortgage, you're paying for a loan. A mortgage is essentially a secured debt. The word itself comes from the old French mortgage, which literally means dead pledge. Dark, right? It's called that because the pledge, the debt, dies when you pay it off or when you fail to pay and give up the property. The bank is betting on you. They're giving you a massive pile of cash, hundreds of thousands of dollars, to buy a building, and in exchange, they hold the deed as collateral. If you stop paying, they don't just say, hey, please pay us back. They take the house. That's why it's secured. That house is the safety net for the bank. Okay, picture a giant pie chart. Every mortgage payment you make goes into a bucket, but that bucket is sliced up in different ways over the years. There are three main concepts to your monthly bill: principal, interest, and escrow. Principal is the actual amount you borrowed. If you borrowed $300,000, that's your principal. Every dollar of your payment that goes toward principal is a dollar of equity. That's your ownership stake. You're building in the house. Interest is the rent you pay to the bank for the privilege of using their money. This is how they make their profit. In the early years of your mortgage, your payments are heavily weighted towards interest. Lastly is your escrow. This is the part people often forget. Beyond the loan, the bank wants to make sure the house doesn't burn down and that you pay your property taxes. So they collect a little bit extra every month, put it in a savings account, the escrow account, and pay your homeowner's insurance and property taxes for you. Here's a fun, slightly depressing fact. On a standard 30-year fixed rate mortgage, for the first few years, your monthly payment is roughly 80 to 90% interest. You're barely touching the principal. It feels like you're running on a treadmill, but you're actually making progress. It's just very, very slow. You probably heard the word amortization. It sounds like something you find in a chemistry lab. All it really means is the mathematical schedule of how you pay off your loan. Banks use a formula that ensures your payment stays the same every month. That's a huge benefit. Rent can go up every year, but your mortgage payment, the principal and interest portion, stays locked in for 30 years. That's the fixed rate magic. But because the payment is the same, the math has to shift. In month 1, you owe the bank interest on $300,000. In month 360, the final month, you owe interest on only a tiny fraction of that remaining balance. So early on, most of your money goes towards interest. By the end, almost all of your money goes to principal. This is why, if you want to pay off your house early, you should throw probably an extra little bit towards principal in the first 5 years. A $100 extra payment in year 1 does way more damage to the total interest you pay than a $100 extra payment in 25 years. So you want a house. You go to the bank and they ask for a down payment. Why? Why can't they just lend you 100% of the value? It's all about risk, my friend. If you put 20% down, you have skin in the game. If the housing market drops by 10%, you still owe less than what the house is worth. But if you put 0% down and the market drops 10%, you have negative equity. You're underwater. You owe the bank more than the house could sell for, which makes you a high-risk borrower. If you don't have that 20%, banks often require private mortgage insurance. It's an extra fee you pay every month that protects the bank if you default. It's basically insurance for them, not you. One of the biggest feelings for a homeowner is the day your equity hits 20%. And you get to call the bank and say, hey, cancel that PMI. It's like getting a raise overnight. When you're looking at loans, you'll see fixed rate and adjustable rate. A fixed rate mortgage is a bet that the bank is making against history. They lock you into, say, 4% for 30 years. If inflation goes crazy and the market rate jumps to 8%, the bank is stuck losing money on your loan compared to what they could get elsewhere. An ARM is the opposite. It starts with a lower interest rate, but it resets every few years based on the current market. If the economy stays stable, you win. If interest rates spike, your mortgage payment could balloon, and suddenly you're in a house you can't afford. My advice: most people are better off with the fixed rate. Life is unpredictable enough without your housing payment being a gamble. Here's the thing I really want you to take away from this episode. A mortgage isn't just a number on a statement, it's a tool. When you get a mortgage, you are essentially leveraging your future self to provide stability for your present self. You're trading a portion of your future income to own the ground you stand on today. There's a strange, quiet power in owning your home. When you're renting, you're always a guest in someone else's investment. When you have a mortgage, every time you paint a wall, upgrade the kitchen, or plant a tree, you're strictly increasing your own net worth. Even if the bank owns the deed, you own the asset. So don't be intimidated by the paperwork. Ask questions. Ask your lender, how much of my payment is going to principal? Ask them, what is my total interest paid over the life of this loan? It's your money, it's your future, it's your house. Understand the machine you're plugging into. Thanks for hanging out with me today. I hope this cleared up some of the fog around the mortgage process. It's a big mountain to climb, but the view from the top, when you finally make it and make that last payment, is pretty unbeatable. If you found this useful, share it with a friend who's currently staring at a mortgage application with that deer in the headlights look. I'm G, and this has been Stuff You Should Think About. Take care of your finances, take care of your home, and I'll catch you in the next one.